Hi everyone, welcome to today's webinar. Our topic today is Federal Residential Tax Credit Eligibility for Community Shared Solar Panel Owners. This webinar is a presentation of the Clean Energy States Alliance, also known as CESA, and our host today is Project Manager Nate Hausman. And before I pass this over to Nate, who will be introducing our guest speakers and talking a bit more about our topic today, I'd like to go over just a few quick housekeeping notes. All of our participants today are in listen-only mode. This means that you can hear us, but we can't hear you. And you have a couple of options for joining the audio portion of our webinar today. You can use your telephone or your computer mic and speakers, and please follow the instructions on your webinar console when you do that. A very important request, please submit your questions throughout the webinar as you think of them. And you can submit them using the question box on your webinar console. So please type those in as you think about them. We'll be reviewing your questions as you send them, and we will queue them up for a Q&A at the end of our presentations today. So type them in as you think about them. We'll answer them at the end as time allows. A final note, this webinar is being recorded. You will find a recording of this webinar as well as slides on our website at cesa.org/webinars, and that should be posted within 24 hours, and you'll also get a follow-up email about this. And with that, I'd like to pass it over to Nate Hausman.
Thank you, Samantha, and welcome everybody, and thanks to everybody for joining us today. As Samantha noted, my name is Nate Hausman, and I'm a project manager for the Clean Energy States Alliance. Just to give folks a little bit of background about the Clean Energy States Alliance, or CESA for short, we're a national nonprofit organization working to advance clean energy. Primarily, we work at the state level. At our core, we're a national network of public agencies that are individually and collectively working to implement smart energy policies and programs. Next slide. CESA's public agency members include many of the most innovative and successful and influential public funders of clean energy initiatives in the country, and so here you have a sense of the scope of who our members are. Next slide. So before we launch into the topic at hand, I wanted just to give a little bit of background about community shared solar. Community shared solar is sometimes referred to as just community solar, solar garden, shared solar. It can travel under a number of different names. But the basic notion is that it allows many different electric customers to gain the economic benefits of solar photovoltaics without necessarily having the array directly located on their own real estate. Community shared solar projects typically allocate the generation, the electrical generation, from a jointly owned system, or maybe it's a third-party owned system, to offset those multiple customers' electricity consumption. Community shared solar has lots of benefits and is a potent tool, we think, for solar deployment, in part because it can leverage economies of scale. It can be installed. It can be installed on lower value land. Customers like renters can participate. You don't necessarily need to be a homeowner to have an interest in the system, and it doesn't necessarily require high entry costs to participate. And there's a lot of flexibility in the project structure, which we'll hear more about later on in this webinar. Community shared solar is often facilitated by supportive state policies such as virtual net metering or group net metering. In some cases, it's electric utilities that offer community shared solar programs on their own. It's a rapidly growing market. 13 states and Washington, D.C. have established policies for community shared renewable energy deployment. And there's, as I noted, it's growing rapidly. Some predict that the community shared solar market in the U.S. will expand some 7-fold over the next couple of years. Next slide. So CESA, we're working through a solar cost reduction partnership project. We've engaged we're engaged in work with state partners to reduce the non-hardware costs of solar PV. So as part of this work, CISA convened, this was in February 2014, we convened a stakeholder meeting that included industry representatives. And at that meeting, some of the feedback we got from industry representatives there was that there was uncertainty about whether or not an individual owner of solar panels in an offsite array qualified for the ITC under Section 25D of the U.S. tax code. And so that's what we said, having heard that there was market uncertainty, that's what CISA set out to tackle, and we decided to try and shed some light on this issue by engaging the services of Foley Hoag attorneys Adam Wade and Nicola Lemay. After sussing out our options, we ultimately decided that the path that we chose to pursue would be a private letter ruling, and we found an appropriate petitioner, Roland Marks, who is a solar panel owner in a community shared solar array in Vermont called the Boardman Hill Solar Farm. Next slide, please. There's a picture of the Boardman Hill solar farm being installed. CISA underwrote the private letter ruling request from Roland Marks using the legal services of Foley Hoag, and Adam and Nicola from Foley Hoag are here with us today to talk more about the implications of the private letter ruling. So without further ado, I'm going to turn it over to Adam and Nicola. Next slide, please. I'll just give a little brief introduction about, excuse me, about both of them. Nicola Lemay is chair of Foley Hoag's tax practice and a member of the firm's Energy, Clean Tech, and Renewables practice group. Nicola has extensive experience in the structuring and financing of solar projects, including the implementation of partnership flip structures and inverted lease transactions. Adam is a project finance attorney and a member of Foley Hoag's business department and its Energy, Clean Tech, and Renewables practice group. Since beginning his solar practice in California in 2006, Adam has worked on financing transactions leading to the development of hundreds of megawatts of distributed solar assets across the United States. So with that, I'm going to turn it over to Adam and Nicola.
Thank you, Nate. This is Nicola Lemay, and as Nate indicated, I'm a partner at Foley Hoag. Adam and I thought it would be helpful to walk through from a technical perspective what led to the request for the private letter ruling. I will first briefly review the key statutory language in Section 25D of the Code, and then discuss the limitations of the guidance that was provided by the IRS in a 2013 notice that it issued. Adam will then review the facts and analysis of the particular transaction addressed in the PLR, as well as the broader potential opportunities created for community shared solar as a result of the PLR. Before we turn to the specifics of the Section 25D tax credit, I just wanted to lay the background a bit more as to tax credits in solar projects. Fundamentally, the financing of solar projects still is very much tied to the availability of tax credits. The Section 48 investment tax credit is a business tax credit that is often used to finance larger solar projects and requires investment by a tax equity investor, typically a business that has taxable income and can use the credits to offset its taxable income. By contrast, the Section 25D tax credit is a credit available for individual taxpayers and is the credit that is usually claimed by individuals installing rooftop solar on their houses. So with that background, let's turn to the Section 25D tax credit. Slide 2 lays out some of the key statutory provisions in Section 25D. Section 25D generally provides that in the case of an individual, again, it's a tax credit for individuals, there shall be allowed as a credit against the tax imposed, so basically income taxes, for the taxable year an amount equal to 30% of qualified solar electric property expenditures made by the taxpayer during such year. And key to the question of what is the scope of this credit is the definition of qualified solar electric property expenditures. And generally, the statute provides that that means expenditures for property which uses solar energy to generate electricity for use in a dwelling unit located in the U.S. and used as a residence by the taxpayer. Just generally, everyone should be aware that the 25D tax credit does have an upcoming termination date, which is that the credit will not be allowed for property placed in service after December 31st, 2016. There is, however, a carryover of the credit permitted so that, for instance, if property is placed in service by that deadline, the credit with respect to that property can be used potentially by the taxpayer in future tax years. In 2013, the IRS issued Notice 2013-70, which did provide some additional guidance related to the Section 25D tax credit. The notice was formulated in a question-answer format, and at least two of the questions were focused on the Section 25D credit. Question answer 25 is one of those provisions, and it generally clarified that an individual taxpayer could claim the credit for solar electric property that was not installed directly on the taxpayer's home if the solar electric property generated electricity directly for that home. Viewed, in the most narrow possible sense, this clearly meant that the solar property did not have to be installed directly on a taxpayer's roof. Question answer 26, however, in the notice went even further, and it addressed a scenario under which the solar electric property was not even on the taxpayer's property. The solar electric property was located off-site. So to some extent, we could say that the notice did provide guidance that off-site facilities, off-site solar property could qualify for the Section 25D credit, but the specific scenario addressed in the question actually laid out some pretty narrow facts. So let's walk through in a bit more detail what those facts were. First, the question assumes that a taxpayer purchases solar panels that are placed on an off-site solar array and connected to the local public utilities electrical grid that supplies electricity to the taxpayer's residence. The taxpayer enters into a direct contractual arrangement with the local public utility to allow the taxpayer to provide electricity to the grid using a net metering system. The contract states that the taxpayer owns the energy transmitted by the solar panels to the utility grid until the electricity is drawn from the grid at the taxpayer's residence. The question also assumed that absent unusual circumstances, the panels would not generate electricity for a specified period in excess of the amount expected to be consumed at the taxpayer's residence during that period. The question then is whether the taxpayer under those facts can claim the 25D credit. In the notice, the IRS concluded that yes, the taxpayer under those facts would qualify for the 25D credit. Again, the analysis there was reciting the applicable provision of Section 25D, saying that the solar property has to generate electricity for use in a dwelling unit used as a residence by the taxpayer. And the IRS concluded that the taxpayer's expenditure for the off-site solar panels under the type of contractual arrangement described in the notice qualified for the Section 25D credit. The question answer 26 raised some questions for the community solar. It did open the door to applying the 25D tax credit to offsite solar arrays, but again, because of that language about the, referring to the contractual arrangement and also assuming that there was a single taxpayer that owns the entire offsite installation, both of those factors raised the question of, was that question and answer intended to limit offsite solar to those particular facts, or was it simply an example of when one circumstance in which offsite solar can qualify for the 25D credit? Given this uncertainty, we did speak with the IRS and ask for clarification as to what they intended with that question, and asked if they would be willing to issue any clarifying authority. And the IRS said at that point that no, they were not interested and did not have the bandwidth to revisit and issue any kind of clarification to the notice. That's what led then to the submission of the PLR request. In our discussions with the PLR, with IRS, when we were discussing the PLR request, there they made clear that no, question answer 26 was not intended to address the only scenario in which offsite solar could qualify for the 25D credit. So now Adam is going to turn to a discussion of the specific facts and analysis in the PLR. But before Adam starts that discussion, we just want to make sure that everyone understands that PLRs do not constitute precedential legal authority. PLR is a request by a particular taxpayer as the tax consequences to that taxpayer of a particular transaction. So in general, they cannot be used or cited by other taxpayers as authority or precedent. However, PLRs still do provide insight into the IRS view on specific transactions and are generally viewed as guidance as to how the IRS could view similar transactions. They are clearly used as tools and sort of relevant authority to be taken into account by courts, other IRS personnel, and taxpayers generally. So the PLR does provide insight and helpful guidance to the community solar area as a whole. Adam?
Thanks, Nicola. As Nicola mentioned, the Q&A 26 in the 2013-70 notice suggested a very narrow view of what kind of net metering might constitute use of electricity in a dwelling used as a residence by a taxpayer. I think a number of practitioners will understand that net metering is not so defined in many jurisdictions. In a number of jurisdictions, there may or may not be a direct contractual relationship between the recipient of a net metering credit and that utility. Frequently that's the case, but it is not always true. But most often, the tariffs that regulate net metering are silent as to the retention or passage of title to the electricity that is being delivered to the utility for which a net metering credit is calculated. And that was certainly the case in Vermont with its tariffs. It is the case in Massachusetts as well, which has developed a large and growing community solar industry. I think it is also the case in a number of other jurisdictions. And so for that reason, CISA and we went about the business of finding an individual taxpayer whose commercial facts fit with our understanding of what might be a more broadly useful interpretive written guidance from the IRS. So on our slide that you see now, I've described the structure of the facts that we presented to the IRS. This was a community-led and installer-led program. The installer, in this case, entered into a direct contract with each of the individual owners who wanted to group themselves into a community shared solar project. Each contract was substantially identical, but for identifying the number of panels that each individual would own. And under each of those agreements, the individuals would retain title and ownership to those panels, as well as a shared or undivided interest in that portion of the array that was not so easily susceptible of being divided, such as the racking, the inverters, the wiring, the conduits, and the services and labor provided for the permitting, the development and installation and interconnection of the asset to the utility grid. In this particular array, all of the power generated by the array was delivered to the utility. It was the same utility that provides service to each of the individual owners' residences. The residences were all located within the same jurisdiction, and yet the individuals were not necessarily neighbors in the sense that they lived on the same road or abutted each other's property. For that purpose, they found it useful to form a limited liability company to represent the individual owners in an efficient manner, to provide administrative services to it, to the collective group, for instance, for operation and maintenance, for tax purposes, for insurance purposes, and for the purpose of delivering to the utility a single instruction on how to divide the net metering credit calculated for the array among the individual owners in proportion to the number of panels that each of them owned. It's important to know that the limited liability company here is formed solely for the purpose of administrative convenience. It is not an owner of any of the equipment that is installed in the array. The individuals here each retain and received title from the installer to their particular panels and portion of the array. Under the Vermont tariff, the utility calculated a net metering credit based on the aggregate amount of electricity delivered to it from the array. The net metering credit in that instance is generally equal to a calculation based on the kilowatt hours delivered multiplied by the same kilowatt hour tariff rate that would have been applicable to the utility's service tariff at each of the individual taxpayers' residences. Plus, in the case of Vermont, most likely because Vermont at the time did not have a renewables portfolio standard, an additional solar adder. Each participating individual taxpayer's net metering credit was calculated through agreement in the LLC among each of the individuals to be a percentage of the solar array's aggregate net metering credit based on the number of panels owned by those individuals relative to the number in the array as a whole. And the utility would then, by its tariff and procedures in accordance with Vermont law and regulation, apply that portion of the aggregate net metering credit as a credit against the amounts that were due by that individual taxpayer under their invoices issued by the utility for the purpose of providing electricity to that individual taxpayer's residence. In no place in the tariff or regulations for this project is there an assertion as to which person retains or holds or passes title to the electricity generated by the system. Net metering is defined in this instance as simply an accounting arrangement. And so the facts here fit with our intention of trying to make the Q&A 26 less limiting to find a written statement from the IRS that would be more in sync with what we think of as the usual form of accounting-based net metering. It was important to us in reviewing the Q&A in Section 26, as well as the statutory authority of 25D concerning use in a dwelling, to distinguish the taxpayer's individual consumption motives from what might have otherwise been potentially characterized as engaging in a business. Each of these individual consumers, these individual taxpayers, agreed with their installer that they would purchase a number of panels that would be reasonably sized to approximate what kind of electricity consumption they have at their individual homes. In the particular instance of the taxpayer petitioner, he'd identified that he would buy panels that would produce approximately 90% of the aggregate amount of his electricity consumed in a particular year. And for that reason, he expected that the panels will not generate electricity in excess of that amount. It also was expected that the individual's net metering credit will not be in excess of the dollar values of the amounts that the individual owes to the utility for the provision of electricity services in his residence. This is an important fact and was a very helpful fact in conversations with the IRS to distinguish what the taxpayer's consumption motives were and to understand that there was no intention, for instance, for each taxpayer to generate net metering credits which would then be sold in exchange for cash. The LLC, as I mentioned, is purely an administrative entity, and yet for corporate LLC purposes, each individual was a member in the entity. But the LLC agreement expressly recited that the entity does not hold any ownership interest in any of the panels or the ancillary equipment or wiring. It was formed instead solely to represent the common interests of the members in an efficient fashion, to communicate with the utility, and to periodically collect and disperse funds on behalf of the members to pay third parties for insurance, to pay taxing authorities, and to pay for services from qualified third parties to perform operation and maintenance in the customary fashion. It should be understood that the LLC form was simply the form chosen in this particular instance. Developers and community interested groups should pay careful attention to choice of entity for the administrative vehicle and take into account any federal and state securities regulations. In some instances and jurisdictions, a cooperative corporation may be a logical choice, but it's not necessary for the entity to be an LLC or a cooperative corporation.
So we've now walked through some of the Section 25D statutory language, Notice 2013-70, and the particular facts addressed in the PLR. So what are some of the takeaways that we see from the PLR? First, the PLR shows that Notice 2013-70 was not intended as a statement of the IRS position on the requirements for off-site net metered solar installations to qualify for the Section 25D tax credit. In particular, an off-site net metered solar array with multiple individual taxpayers as owners potentially can qualify for the Section 25D tax credit. But a couple points should be noted here. First, the PLR does not address joint ownership of solar panels. Under the facts of the PLR, any single solar panel in the array has only one owner. There is, however, proportionate shared ownership in racking, inverters, and other portions of the solar array. So the IRS did not appear to be disturbed by that fact. Also, the PLR shows us that the individual taxpayer does not necessarily have to be a party to a direct contract with a utility or retain legal title or otherwise have legal title addressed with respect to the electricity generated by the off-site solar array. The PLR also shows that the electricity produced by the array can be based on a percentage type of determination as far as what's allocated to a particular taxpayer, rather than requiring direct tracking of the electricity produced by particular solar panels.
The final takeaway on our slide refers to the administrative entity used, in this case, as an LLC for the facts of this private letter ruling. The observation here is, even though there was an entity involved, the entity had no ownership interest in the assets which qualified, the purchase which qualified as a solar expenditure. It's not necessary for, in our thinking, there to be an entity, but people do frequently and efficiently organize themselves through cooperatives and LLCs. It could just as easily have been a contractual arrangement among the individuals, appointing one among their number to act as agent on procuring the necessary third-party arrangements and communicating with the utility. Management of these entities by installers or groups of individuals or third-party agents is an emergent and important aspect of the corporate structuring of structures that may focus on these facts. And some thought is warranted in putting together these entities, managing these entities, and providing for a fund of a pool of funds to be used for their operation. In sum, I think that the PLR could make the Section 25D tax credit more comfortably available, more comfortably used by installers and communities who may come from a broader pool of individual taxpayers. This has the opportunity, if replicated in other structures, of expanding participation in the benefits of solar's attributes to people who do not necessarily own their homes, to people who have roofs which face wrong direction, are old, or are shaded, and potentially to condo owners and renters or others who may have restrictive covenants or zoning problems with installing solar. In a number of ways, the project resembles economics that each of these many individuals may have replicated by putting solar on their own roofs. And in a number of ways, it may have bested those economics due to the scale and the lower installed cost of the solar by building a larger array. Most community solar structures will frequently monetize the Section 48 investment tax credit and the maker's depreciation with a professional tax equity investor, which does have some limitations, not the least of which is on an asset of the size like the Boardman Hill Solar Farm, it's simply not large enough to attract efficient tax equity capital. From the customer's perspective, the Section 48 investment tax credit-driven community solar products may resemble or approximate the economics that individual customers may have achieved by putting a power purchase agreement in place for an asset located on their homes, or perhaps a prepaid power purchase agreement. A number of the structures in the market do provide value to customers in exchange for upfront payments, but do not pass title and ownership of the asset to those customers, and exchange net metering credits on a going forward basis, either in perpetuity in exchange for that upfront lump payment, or on a pay-as-you-go basis for monthly invoices for allocation of net metering credits. This structure has the potential to drive greater customer savings and realize economies of scale so that there are less investment dollars than under the typical rooftop solar transaction, and could improve the economics relative to rooftop installations. As a final point, backing up to my prior slide, there has been an emergence of loan products in the rooftop solar space, which have the benefit of providing the tax credit to individual owners of solar, but without requiring capital expenditure of a lump sum payment or closely spaced installment payments to an installer by well-funded, wealthier individuals. Adding the opportunity for participants to borrow against offsite panels installed in array could help to migrate this trend toward loan products into the community solar space. So that concludes our formal presentation. I understand that we have questions that have been coming in. I'm happy to answer any and all questions.
Great. Thanks, Nicola and Adam. Thanks for walking us through that so carefully. We've got lots of questions that have come in, and I'll just start launching into it. If you do have questions, please feel free to enter those into the box, and we'll get to as many as we can in the time we have left. So first, just a question about just clarifying that there's no precedent for a project to take advantage of the business tax credit under Section 48 and for residential subscribers to take advantage of the 25D credit as well. There's no precedent for taking both credits, in other words.
That's correct. It really does. We've been asked this question a few times, and we've never had to dig into it deeply, but I will say that just on its face, it doesn't seem likely that a project could qualify for both, absent some, intense review and analysis of complex structures. And even then, I think it's quite unlikely that a structure would result in being able to use both.
Great, thanks. Another question, someone noticed that in the particular petitioner PLR request involved the same state as the panels were located. Is that a relevant fact in terms of the IRS's analysis, in your view?
In our discussions with IRS, both verbally and in follow-up written product that we were asked to deliver to them, they were concerned that there be some relationship that between the electricity generated and electricity consumed and the utility itself. So from the tax perspective, IRS did not necessarily indicate that they were inclined to permit a 25D tax credit for a system in which customers came from multiple states across different utility territories. The key piece of that was the common utility territory. I think that for the most part, distribution companies' utility territories are circumscribed within state boundaries. There may be exceptions that I'm not aware of. I can't say that the utility territory bleeding over into another state would be a problem for the IRS. I do think that there does need to be demonstrated some actual relationship that's in common with the utility, so that there is the same utility receiving the power from the array as provides it to the residents of the individual owner.
And I will add, I think Adam answered the question very accurately as to the tenor of our conversations with the IRS. I just do want to emphasize it actually was one area that the IRS did focus on very carefully in the questioning. They did not seem to like the idea of cross-state transactions, but again, the extent to which as Adam was saying, the same utilities involved, et cetera. If that would help, maybe, but clearly the IRS had concerns about it.
And if I could just add on, I think that, I know it's not the scope of this discussion, but interstate transactions that do not involve allocation of net metering credits should be closely reviewed for securities compliance. If out-of-state individuals are asked to purchase panels located in a different state and receive cash payments in return, I would recommend a scrutiny from securities perspective.
And in any situation, again, we're focused on net metered installations. In any situation where there are facts that indicate any kind of cash payment to individuals, that's an entirely different world of both of tax analysis and is not at all the topic of the conversation today.
Thanks. You noted pretty clearly that there was singular ownership of a particular panel or module in the arrangement at issue, but shared ownership of equipment and racking and those kinds of things. In your view, is that a relevant distinction? Could you fractionalize a module, or even more so, do you think common ownership, joint ownership of all equipment in an array would be relevant to the IRS's analysis?
We did not discuss or raise that factual scenario with the IRS. Our facts, we were keeping our facts sort of as clear as possible in line with the statute. I am guessing that if we had a conversation with the IRS, they may give us some insights into their view on the issue. I would say, however, that joint ownership, especially of an entire solar array, likely will lead to setting aside any tax concerns and questions, will likely lead to other securities law issues and questions that would need to be addressed. But the short answer on the tax side is that no, we did not address that question with the IRS, so we do not have particular insight into the IRS view on that question.
Anything to add, Adam?
No, I think that says it. I think that the concept of joint ownership of property is still very much a concept of ownership of the property itself. And yet, even if, for instance, the LLC entity were to own the assets, well, I think, first of all, in that situation, you would have a securities concern because people own a indirect interest in the asset. The entity actually owns the asset. Maintaining ownership among a common group of individuals could still have some securities concerns as potentially an investment contract, depending on how it's structured. I think one of the key aspects of both the IRS analysis here and the securities analysis is the consumption motive, demonstrating that no more of the assets were purchased than were necessary to generate electricity reasonably expected to be consumed in the residence. But as a technical matter, joint ownership of the panels was not a fact that we presented to the IRS. They did understand that it was simply not feasible to have individuals own particular parts of the racking or the inverter. They just weren't susceptible of being separated in so clear a way.
Great. Yeah, we're getting lots and lots of good questions in. A lot of questions sort of trying to extrapolate on the existing analysis in the private letter ruling to understand how the IRS might view other things. Along those lines, do you think it would be a relevant distinction if a participant in a program to try and capture the tax credit if they already subscribed to a community shared solar array that had been commissioned? In other words, if there was an owner coming into an already existing project, do you think that would be a relevant in terms of the IRS analysis on this point?
I assume I'm going to maybe re-ask the question. I assume that the question is if, for example, 100 individuals put in service an array under facts similar to Boardman Hill, and one of them moves out of the utility service territory and decides to sell their panels and their interest in the array to another person, would that buyer be permitted to take the tax credit? I think the answer is likely no. I think that the solar expenditure is for assets placed in service. Placed in service language in 25D is not necessarily the same as you would see in the Section 48 business investment tax credit context, but I do think it's a relevant point. I would say that careful attention to how transfer of ownership of the asset, and for that matter, relationship with the administrative entity is structured, really is a very important area to give business consideration to, as well as securities and tax consideration, so that, for instance, it's clear to tax regulators and securities regulators that individuals are initially buying into these structures for the purpose of generating electricity to be consumed in their residences, and not as a way to profit or to purchase something for later sale, or to purchase something for the generation of net metering credits which can be sold to supplement their income. I think that's a careful point for practitioners to consider and for developers and consumers to consider when looking at similar structures.
Thanks. Nicola, in your slides you mentioned you got into some of the reasons why strategically a private letter ruling was pursued versus some kind of wider guidance. I wonder if you could extrapolate on that. In other words, it seems like the private letter ruling being only binding on the particular petitioner is pretty narrow. Is there room for some kind of wider guidance on this moving forward, or is what we get?
It seems very unlikely at this stage that the IRS would entertain issuing any wider, more widely available guidance that others could rely on. When we spoke with them and we did push quite strongly to get them to agree to do that, and the pushback was equally strong that they would not. And one reason was that there's this looming expiration date for the credit, so the IRS is viewing it as something that really didn't have the value in the long run that merited their limited resources being devoted to more time to address it. That was one factor, and probably a significant factor. But just generally, they just were not interested or willing to do that at this point. Now, let's say the credit is extended. Let's say the IRS realizes, hey, this ruling, this private letter ruling, has actually generated a lot of interest, and there are significant issues here affecting an entire industry. Maybe at that point, the sort of view within the IRS towards issuing wider guidance could change. But at this point, I think it's very unlikely based on the conversations we had. And that is why we ended up going the route that we went. It seems like the only option to sort of get guidance that at least would provide to the broader community some kind of insight into the IRS view on the scope of and availability of 25D credits to offsite solar.
I think that's right. Nate, I mean, our shared goal with CISA was to receive from the IRS some written work product that made clear that Question 26 was not meant to be construed so narrowly as to always require retention of title and to always involve a single owner of the asset. Those two items were key to coordinating the aspects of community solar that to us seem most powerful commercially and for the benefit of consumers and taxpayers, and for that matter to the IRS for getting more solar per tax credit dollar. And that was allowing people to come together to build assets at a larger size so they could realize economies of scale, drive down the installation costs, and to do so taking full advantage of the form of net metering that we most frequently see in states and utility territories that embrace full retail net metering. And anecdotally, what we found when we asked them about the 2013-70 notice and the Q26 in particular was that the Q&A was, if you will, it was sort of their last word. They were clearing their desks, in a manner of speaking, of all of the questions that they had received on 25D, and yet were quite sympathetic to our point that the Q26 represented a rare and peculiar form of net metering and could cause a lot of confusion in the market because you rarely see it. Was retention of title really necessary in order to document that there was consumption and use in the dwelling? They told us verbally no, but we really needed something in writing, and the PLR ended up being our only choice.
Thanks. Yeah, there's a lot of great questions coming in, sifting through them as best I can here. Question, and you touched on some of this stuff already, but do you think the state net metering laws or utility net metering tariffs, the particular tariffs at issue, are significant for the purposes of this PLR? In other words, does the same reasoning, would that apply in Massachusetts or Colorado? Yeah.
I can answer for Massachusetts most directly because I'm intimately familiar with the net metering tariffs. The answer is yes. I think that there is no distinguishable difference between the tariffs in Massachusetts and Vermont for the purpose of demonstrating that the electricity is used in a dwelling, as the statute says. I don't know that Colorado, I know Colorado has a very specific form of statutory authority for community solar projects, very specific and fine-grained. I will say that I think that I am talking about net metering, but I think that it's reasonable to think that some form of bill crediting that is not necessarily called net metering could also stand in and substantiate this relationship between the individual taxpayer owner and its utility and the power that the utility receives from the array that's owned in part by that individual.
I think the underlying, even though there is little express guidance on what the fundamental underlying tax analysis is of net metering transactions, it does seem inherently what the analysis is the individual taxpayer essentially getting an adjustment to their purchase price for their electricity. When you view the steps of the overall transaction as a whole, that there's electricity being delivered to the grid by property owned by the taxpayer that doesn't exceed the consumption needs of that taxpayer, and the utility is giving them a credit on their bill, not cash, but a credit on their bill. And so that I think underlying the analysis is can the overall transaction just really be viewed from a tax perspective as an adjustment to that individual taxpayer's price for electricity? And I think when I would approach sort of other net metering statutes, I would have that in the back of my mind of analyzing the overall transaction and relationship of the taxpayer and the utility and the net metering transaction to see if somehow that diverges from that fundamental analysis.
Thank you. Another question. Do you think there would be any concerns with an installer providing the administrative entity role in lieu of a separate entity like an LLC, assuming the installer executes an arrangement with each individual taxpayer? Does that raise any concerns for you in terms of the IRS analysis on this?
I think the key of the role of the administrative entity is that it does not have any ownership interest in the assets. That's the key piece of the analysis, I think, for IRS's purposes here. I think that the installer plays a very significant role in, first off, building the asset and coordinating the individuals who form the group. At some point, it may be up to the group how durable and permanent that role might be. I think it does seem, from just purely commercial perspective, seems quite natural that the installer might help overcome a collective action problem of managing a disparate group of 100 or so, or 30 people, however many there might be. You know, communities are not necessarily ready-made or self-forming, so the installer can provide a pretty important business role in that.
Great, thanks. Well, we're getting closer to the top of the hour here, so I'm going to ask one more question, and then I'll give you a chance to have some final thoughts on the matter. This is sort of a broad-ranging question. In light of the private letter ruling that's been handed down, what advice do you have for someone structuring a project to take advantage of the residential ITC? Are there particular paths that you think are really promising?
Well, the easiest answer there is to structure a transaction to replicate the exact facts of the PLR, subject to, of course, the administrative vehicle, any considerations relating to non-tax issues relating to how that is structured, that relationship, and the type of entity used. That is the, I think, easiest answer. The other points, I think it's hard to sort of speculate as to all the different potential structures and arrangements here. So I think I'll leave it at that. Adam, do you have thoughts?
I would add that, you know, notwithstanding how narrow Q&A 26 was, the remainder of the 2013-70 notice did include some useful guidance on what parameters the structure would include. For instance, there are some questions and answers related to, well, what if I have more solar than I need? What if I overgenerate? What if part of my solar is providing electricity to my business? You know, what if, and a number of other scenarios I can't think of at the moment off the top of my head in that notice. I'd say that you take the authority that we have here with this PLR together with the Notice 13-70 and 25D statute, you know, as well as the IRS's other announcements on 25D generally, and consider that IRS is most concerned when they apply the 25D statute to an offsite system that the taxpayer can demonstrate consumption motives, very similar to the consumer protection and securities analyses on these structures. Tying the home electricity bills to the purchase contract and making sure that an individual buys no more solar than their bills would suggest is justified, or within a margin of error, or making sure that people cannot buy into these structures and then resell them at a profit, or transfer their net metering credits for revenue, that they would actually use them in their home utility accounts rather than freely transfer them in exchange for money. I think those are some of the key points that we took from our discussions with the IRS, and they certainly are here in this private letter ruling, if even just in a very skeletal and terse kind of a way.
Thank you. Unfortunately, our time is up. An hour has gone by. I do want to just once again thank you, Adam and Nicola, for your responses and your presentation. I thought it was really informative and really helpful webinar. And thanks everyone for your thoughtful questions as well. I'm sorry we couldn't get to all of them. I do want to give Adam and Nicola a chance, just any last thoughts before we sign off here and I turn it over to Samantha.
Thanks, Nate, and thanks to CISA very much for identifying this opportunity, and to Roland Marks and the Boardman folks for cooperating with it. I think it was a great example of how the community can work among different groups and representatives to coordinate state and federal policy. I would say that we have no other parting thoughts, but it sounds like if there are questions which have not been addressed, either Nicola or I would be happy to see them by email. Our email addresses are on the last page of our slides, which will be posted by CISA. Mine is awade@foleyhoag.com, and Nicola's is nlemay, Lemay, at foleyhoag.com. We'd be happy to continue the conversation.
Great, thanks. Well, with that, I'm going to turn it over to Samantha to close it out.
Thanks, Nate, and thank you, Adam and Nicola, for your great presentations. Everyone who attended, thank you all as well. This webinar was recorded, and it will be posted on our website sometime this afternoon, along with webinar slides. And you'll be able to find that at cisa.org/webinars. And that web address also contains information about all of our upcoming webinars. Thanks very much, everybody.